everyone. The outlook on the bond market in 2012 presents a challenge for fixed income investors, since it totally depends on the evolution of the European debt crisis. For most investors in bonds, performance in the year ahead may well be determined by events that unfold in Europe. All eyes are on the Eurozone and its debt crisis. So, will the debt crisis remain the key market driver in the coming year? And what does 2012 hold for bond markets? Koen van der Maele, Global Head of Fixed Income at Dexia Asset Management, is with us today to focus on these questions. Hello, Koen, how are you?
Fine, thank you.
So, welcome. Will the sovereign debt crisis remain the key market driver for 2012, or should we expect some change in the economic environment in the coming year?
I'm afraid that the sovereign debt crisis will remain the focus of the financial markets, at least for some months to come. You should know that excessive debt levels cannot disappear overnight. You need some time to lower debt level. Nevertheless, we think that the tensions in the government markets will ease once some final decisive steps on the European level will be taken. We think the only viable solution today of this sovereign debt crisis is to go to a closer and deeper economic cooperation on a fiscal and economic level.
Because that's the problem today.
That's the problem today, but it's not that easy because it requires some transfer of powers from the national level to the European level, and it's a process that should take many years if we were not in problems today. So we need to hurry, and it's a difficult process. So we think that the pressure of the financial markets will continue to be needed in order to advance in these steps and to achieve the closer fiscal and economic cooperation on the European level. So we prepare ourselves for another volatile year in government bond markets.
Well, Koen, in such an environment, probably a good alternative could be corporate bonds.
Well, yes and no, but not surprisingly, the sovereign debt crisis will have its impact on private companies. For instance, banks, they are closely linked to the sovereign debt quality, and as you know, banks hold large amounts of sovereign debt on their books. Mm-hmm. On the other hand, you should know that the upcoming recapitalization of the financial sector would help the stability of senior financial paper. Mm-hmm. And additionally, the European Central Bank, we trust that it will continue to provide ample liquidity to the financial sector in order to give them some oxygen. But the most important element to us is to look at the effect that the austerity will have on the economic growth within Europe. Today we see a huge lack of growth promoting measures, mm-hmm. which will mean that the Eurozone for sure will end up in a kind of recession in the coming quarters. And that's negative for companies also, because even though they may have a balance sheet which is of decent quality,
right,
the top line revenue will be hampered by the lower overall economic growth within Europe.
What about currencies now? What are your forecasts for next year?
Well, currencies, as long as the Eurozone did not find its final solution, we think that investors will continue to look for alternatives. They will look for the Swiss franc and the Japanese yen. But that's what they did in the past when there was a kind of financial turmoil. Today we believe that these two currencies are already overvalued.
All right.
So there is no value left anymore. Mm-hmm. So we would rather look at the US dollar. There we see a potential to go to 1.25, even 1.20 on a longer term horizon, also helped by the better economic sentiment in the United States.
So we're not talking about the euro a lot, right? We focus on the other currencies.
Exactly. And also to look at other currencies of countries that have a lower debt. I'm thinking of Norway. Norwegian krona is a currency that we do prefer because Norway has an external and a fiscal surplus, mm-hmm. which is quite rare these days. And also in Australia, the Australian currency, even though it may seem expensive against dollar, against euro, we really believe that there is still some value left.
What advice would you like to give to investors in this difficult economic climate?
Well, so the advice that we would give today is to start the year quite defensively. We clearly believe that the European debt crisis is not yet over. Nevertheless, we stand ready to take the opportunity, to benefit from opportunities once the extreme stress will come back into the markets. And then we are mainly looking at maybe buying covered bonds or mm-hmm. senior bank paper, or even looking at government bonds in Italy and Spain. But for those investors that are quite risk averse, we would advise to look at really safe haven bonds, really strong AAA countries, Australia, Canada, Norway, Sweden. On the other hand, for investors that would like to have a little bit more return and less risk averse, there are two elements that we would like to put in the spotlight. These are emerging market bonds. I'm thinking of, especially within the emerging markets, Gulf region, Qatar and other countries offer a decent return for the limited risk. and also high yield may be a good opportunity, especially in the United States.
So there are still opportunities in the market?
There are still plenty of opportunities, yes.
Welcome. Thank you very much for coming today.
My pleasure.
And we will, of course, continue to keep an eye on the evolution of bond markets and come back with more news very soon. Thank you for watching us, and goodbye.